A mortgage prisoner refers to anyone that's trapped in their current home loan, unable to refinance. And with rates on the rise this year and potentially with more to follow, are we going to find there's more and more people getting trapped with their bank and unable to refinance? So in this video, we're going to work through what a mortgage prisoner is, if you're going to potentially fall prey to this, and the steps you can take to look out for yourself. So let's kick off from the top. Like I said, a mortgage prisoner is essentially someone who's had a loan. You might have bought your first home, might be really excited, it's all really good, but it might come down the line, the bank gets less competitive, you want to get a better rate, you might want to switch products, interest only, different things, but you're stuck. The bank doesn't let you do it.
Now, with being a mortgage prisoner and rates going up, right now they're talking about potentially another 5 rate rises between now and the end of the year. This is becoming more and more of a common thing. We're getting borrowers call us being a little bit worried about their affordability and meeting repayments. So Jaden, let's walk through with the first type of mortgage prisoner, which is a valuation. So you could be a mortgage prisoner if your valuations stack up. So what does this look like?
So the most common mortgage prisoner that's been caught by their valuation, some of that might have bought their property at a high value. So you might have spent $500,000, fast forward a year or two, and your property's gone down to $480,000, $470,000. And the bank, when they go to revalue it, says, oh, actually, it's not worth what you paid. And unfortunately, either have to pay lender's mortgage insurance to switch, or you actually don't have enough equity in the home to sell.
Now, this is something that we might start to see more and more, because with property prices increasing as fast as they have, they might come down a little bit, and particularly if you've leveraged the property quite high. And as Jaden said in that example, where valuations soften, that's where you might find you can't refinance.
The other common reason we see people trapped because their valuation is they might have done, say, like a cash out. They might have pulled some equity out from the home. They might have owned it for 10 years, and then say last year when property values were at their peak, revalued, the bank said, congrats, Nate, you're a smart guy, your property's worth $1 million, we'll lend you up to $800,000. And then fast forward to 6 or 12 months down the track, you want to get a new valuation done, maybe your home's only worth $900,000, and you're going to run into problems because then you've got less than 20% equity. That's all sorts of problems.
So couple quick easy tips to get around valuations if you are having issues is, number one, work with a mortgage broker. Your mortgage broker can actually get a number of different valuers out there to see, because one valuer's opinion might be completely different to another valuer.
Even different banks have different types of valuations. So I had a situation recently for one of our clients where they went through their existing bank, they got what's called a desktop valuation. So essentially the computer says, yep, your unit's worth $450,000, all good. When it got to go through the assessment process, the bank said, oh, actually, we want a full valuation. We want someone to go out and inspect the property. And at that point, the valuer that went out there said it's only worth $400,000. So it was worth 50 grand less. It caused all sorts of dramas. Went to another bank, they did an electronic valuation. They did like what's called a drive-by. It was worth $480 and it was all good. So that different type of valuation can even mean the difference between owning your home, getting the next property, refinancing, and not being trapped.
So I think if you are having issues with valuations, remember your mortgage broker is there to help, and we can help with, if you have questions around that. We work with lots of clients in similar situations. So I guess the first thing, if you are having issues with refinancing and being a mortgage prisoner because of your valuation, some practical tips are to look at revaluing with different banks.
Now the next type, or next reason that you're going to get caught and become a mortgage prisoner is for borrowing power. So Nathan, just explain, I guess, even in light of some of the changes with DTI and that, why you would get trapped as a borrowing power mortgage prisoner.
Yeah, we've seen recently with regulatory intervention where the banks are starting to be told by the regulators that they need to reduce the amount that they lend to borrowers effectively. So if you got a loan 12 or 24 months ago, you might have actually purchased at a time where the lending criteria were different and it was easy to get a loan. Fast forward to today, you might find yourself in a situation where the banks actually say you can't lend the money.
There's a couple of different things that can impact here. One common one I've seen is the way that banks might interpret bonus or even self-employed income. We had a customer that recently, 2 years ago, got their loan approved. The bank was only looking at 1 year's tax returns, 1 year's financials, and said, yep, we don't care about the last year's, that's all good. Fast forward to today, the bank changed their policy and said, oh, actually, we need the average of the last 2 years. And if it's a lower year, we'll use that, and it's just no go. So again, having a broker to help you navigate that, it's an easy way to fix it. Another thing that's going to impact borrowing power is the interest rates and how they change. So Nathan, if we look at this example, someone who's on say $70,000 a year with the current assessments rates might be able to borrow say $530,000. But if the rates say go up by 1.5% to 7%, the $530 becomes $450. So as you can see there, if rates go up by 1.5%, it's potentially reducing your borrowing capacity from 530 to 450. It's a big difference. And if you originally got your loan for 530 and trying to refinance today, you can be stuck.
Now, an easy way to work around this, once again, is every lender's got a different assessment. They've got different policies on how much income they'll use. If you've got bonuses, even overtime, some lenders will take 100% for certain industries, others will only take 80%, which makes a big difference on your ability to afford. So once again here, if you are finding you're a mortgage prisoner, unable to reborrow or refinance, this is where, once again, working with a broker will help you understand what's possible.
And the third way you can get trapped and you're not going to be able to refinance is lending criteria changes. So there's going to be a couple of different things we can unpack here. One common one that I've seen at the moment, Nathan, is suburbs and postcode restrictions. So how could this impact you if you bought a unit in the city? You could have even bought a house in the suburbs and the banks changed their mind.
Exactly right. So some lenders actually restrict the amount of properties they'll have in a certain area or a certain postcode, or even have a development register where they say they'll only take a certain number of properties in a certain area. So you might find you're trying to refinance your property to get on a lower rate, and the bank looks at that property and says, nope, we won't take that one because we've got too many clients in that property already.
Yeah, I had this recently with a client that bought an apartment building in Toowong in Brisbane here. They bought it 2 or 3 years ago. At the time, the bank's like, yeah, totally fine, 90%, all good, have at it. They've since come back, looking to buy an investment property, said, let's get cash out against that unit. I want to ideally stay with my same bank. We went back to that bank and they changed their policy, basically because they'd lent to too many people in that one unit. And now you need to have at least a 30% deposit to be able to buy in that unit. So there's no point, we have to look at other banks. Fortunately, we're able to fight other banks that were able to kind of land up to that 90% again and get everything moving forward. So I guess the big tip there is definitely look out. That's probably one policy. Another might be a change in circumstance or job. So what's a common one, Nathan, when you see if people have changed jobs, time and role, like how's a way to get around that? And what's a common scenario you might see?
Yeah, now a big thing here is if you're casually employed or in a contractor role, the banks are looking for consistency here. So typically they want to see, sort of 6 months. Some lenders will look at 3 months in role. So if you've recently changed role, this is where it can become a little bit tricky to refinance and find another solution.
Yeah, I had another one recently where a customer had changed roles. They'd gone to their bank and said, hey, I've been in this role for only a month, but I've been in the industry, I've been in the same thing for 2 years. Bank said, yep, that's totally fine. Like as long as you give us 2 years worth of history, we're going to consider it. It was all good up until the point that the bank found out that there's more than a 30-day gap because they took a month and a half off between the old job and the new job. It was over Christmas, etc. And the bank said, nah, we won't consider it. So again, there's some particularities there where you might be like, okay, I think I meet the policy and there's a gap or there's something different. The bank says, nah, no way. But again, fortunately, different banks have different interpretations. We found another bank that said one payslip is all you need. We're totally fine about that. That's all good. The other one we're probably seeing a bit, Nathan, is like change in life circumstances. So I know like school fees, you might be on maternity leave. How's that sort of impacting things at the moment?
Yeah, big things have changed, particularly around health insurance and school fees. The banks are now looking at this outside of your discretionary ongoing living expenses and have their own category for this, which actually reduces your borrowing ability. Same with maternity leave. A lot of times if you are taking maternity leave or not working at the moment, this is where it can actually reduce your ability to borrow, and you find yourself in a position where you're going to be in a situation where you can't refinance and be a prisoner to your mortgage. So these are things to think out for, especially in a time where we are starting to see rates continue to rise, a little bit more uncertainty out there, and people looking for options.
Yeah, and I guess the reason why you want to sort of avoid this is what they call loyalty tax, because you might be with the current bank, there could be lots of reasons you might want to leave. You might be looking at buying an investment property, you want to get equity out. You might be turning your current old home into an investment and you want to make that interest only. You might be wanting to do renovations and just get a bit of cash off the table and do that. You could even be just looking for a lower rate. You might want to fix in now if you're concerned about interest rates going up further and want to go. So I guess overall, Nathan, what are some of your tips that you're going to give people if you're looking at achieving one of these things and making sure you don't become a prisoner of your own bank and even suffering that loyalty tax?
I think know that there's options out there and you don't need to know exactly what needs to happen, how you go about it. Consult with an expert that knows the details, the intricacies of the industry and can help you get around any problems you're facing. Here at Hunter Galloway, we help hundreds of home buyers achieve their goals of home ownership and even can help with refinancing. So if you're needing assistance, we can help. We're based in Brisbane, but deal with people Australia-wide. So call us on 1300 088 065 or visit us at huntergalloway.com.au, and we'll see you next time.